Coming up in today's video, the stock market takes a plunge, the dollar pushes higher, and gold is having a really strong breakout. Let's talk about all of it. Hey everyone, welcome back to the channel. Today we'll be discussing a mix of commodities, indices, and currencies. As always, all I ask is if you enjoy my videos, make sure you hit the thumbs up button and subscribe. We got some pretty groundbreaking stuff. Starting out, Powell says the Fed would have cut rates this year if it weren't for the tariffs. When asked if July would be too soon for a rate cut, Powell said he can't say, but that he wouldn't take any meeting off the table or put it directly on the table. And arguably, this is a little bit more dovish. And a bit of breaking news that I'm filming later here. We have an update on the Senate, which passes Trump's big bill with Medicaid changes. The House battle is next. Vice President J.D. Vance provided the critical tie-breaking vote to get Trump's bill across the finish line. It now must be reconciled with the House's version before it can go to Trump's desk. And take a look at small caps here responding to the news, up over 1.7%. At one point, it was up 2% plus. S&P 500 is flat on the day now, and the NASDAQ is still slightly in the red. Some very interesting divergence here. Remember that the Russell is comprised heavily of healthcare stocks, financial stocks, and industrial stocks. So clearly what has been passed by the Senate in this bill seemingly is a strong candidate for strength for companies that are in the Russell 2000, the smaller cap companies of America. So really strong push here, and I have actually just trailed my stop further into profit inside of our VIP signals room. Russell remains a very strong pick on the Edge Finder at this time. In terms of economic data though, we did have some interesting stuff come out this morning. Take a look at JOLTS job openings. Came in really strong. Forecast was for 7.32 million job openings. Instead, we got a reported 7.77 million. This is a tick up and definitely welcomed, as the economy has kind of been watching the labor market with a close eye, saying, hey, you know what? Labor statistics are showing signs of cooling. Let's be careful here. Are we going into a recession? But again, a strong job openings number, and this is 2 in a row, is actually a good sign for the labor market. Additionally, this morning we got a better than expected manufacturing PMI number, coming in at 49 compared to the forecasted 48.8. Still in contraction territory, but less contraction than not. It's kind of like if you thought you failed an exam, but instead you just got a D-. It's still bad, but it's not failing. And the EU is toughening its stance on Donald Trump's tariffs as the deadline looms. We know that July 9th date is very important to markets as, again, the US and its trade partners hash out the details as to whether or not a deal can be made. And perhaps this uncertainty is part of the reason why gold is pushing higher here today. I actually ended up getting long last Friday with a stop loss below structure, and we've now seen a nice push to the upside, especially when you drop down to like the 15-minute chart. You can see we've had a really strong push overnight and into the New York session. And institutions continue to have a very strong positioning in gold on the long side. And when we navigate to our COT data history and select gold, you can see that the yellow line represents the long percentage overall over the years. And for multiple years now, institutions have been consistently very bullish on gold. And I find this very interesting because let's just take a look at what gold has done in the last few years. This is a weekly chart of gold, and you can see this thing has been a monster uptrend since 2023. And so tracking institutional money is something that we do frequently on this channel for this exact reason. We want to keep an eye on what the big players at the table are buying and selling. And for a consistent period over the last few years, we've seen a high net long percentage when it comes to gold, sitting at 80%. But for the most part, we've sat around the level of, let's just call it 75% long to short ratio when it comes to institutional positioning, as tracked by our Commitment of Traders data history tool. I think another reason gold has been doing really well has been we've had some recently underperforming economic data out of the US. For example, GDP statistics came in low. However, manufacturing PMIs came in a little bit better than expected today, and JOLTS job openings came in better than expected. So we are seeing a little bit of bullishness for the dollar coming into the picture here, and perhaps that's why the dollar is up today. But before I talk about the dollar, let's talk about the biggest sale that we're doing all year long on the Edge Finder right now. The Edge Finder is a tool that we started construction in 2021, 2022, and launched the product to the public in April of 2022. The tool has come a tremendously far way since it first got launched, and we're currently doing our biggest discount of the entire year for the Edge Finder, which is a 40% off discount. But for viewers and subscribers of my channel, we're offering an extra discount, as you see on the screen right now, a 45% off one-time price for lifetime access access. If you'd like some information about the pricing offers that we do for the Edge Finder, click the first link in the description down below in this video, or the pinned comment below if it's easier for you, or simply navigate to a1trading.com/edgefinder to explore the full list of features, or to go through our free Edge Finder course on our website to explore all the different tools. The Edge Finder gives you access to a tremendous amount of economic data, market sentiment tools like the put to call ratio, Bitcoin to gold ratio, investor sentiment surveys, and of course, our smart money tracking tools like our commitment of traders data and commitment of traders data history tools. Of course, you also unlock access to the top setups algorithm and the variations that we've made for traders who specifically want to look at economic data, or our simplified view, or the sentiment tools, and so much more. Specifically for gold traders, we've seen the Edge Finder really accurate this year in terms of getting the direction of gold correct. During this year, let's actually zoom out a little bit. If we select for a longer period of time, let's go back to like February of this year. And what we can do here is we can see the price of gold plotted at the top and the historical Edge Finder score plotted against the bottom. A score of 5 or greater is considered bullish. And you can see for this year, the majority of the time, gold has been getting a strong reading within the Edge Finder, which has been the correct play this year. We can do a similar study when selecting for the NASDAQ, and you can see the historical score points here on the bottom, and of course the price action on the top. And we can repeat the process for currency traders on things like the Euro US dollar. Here's an example of how the Edge Finder's score has looked versus the price action in the market. So like I said, for a limited time, get 45% off the Edge Finder, and it's a one-time price. No subscriptions, no recurring fees until the end of time, just a one-time payment, and you get access to the tool, and you support our work by becoming a subscriber or a user of the Edge Finder. So check it out, link is in the description down below. So in terms of my position on gold, I do want to continue to hold it, and my plan is to trail stops on this one if we do get some sort of higher low, and specifically I'd be watching for a breakout through these previous highs. So if we get a nice push from here, I have trimmed my stop loss. I slightly had a larger stop loss initially. I've trimmed it just slightly, and my plan here is to see if we can get a push through these highs in order to start trailing stops into profit further. But getting back on track here, is this a potential hammer forming on the dollar index? Well, I wouldn't read too far into it because the dollar index has so much momentum to the downside that I really think we need a string of positive economic data to really get the dollar to turn around. Specifically, we need something like a hot CPI print or a string of really strong jobs data, which we just have not really seen. Now, today is a good start. We had manufacturing PMIs and, of course, our JOLTS job openings, right? In fact, let's use our software, why not? PCE year over year came in a little bit strong for the US dollar. At the same time, we had manufacturing PMIs, and we had JOLTS job openings and last week's initial jobless claims. These are all things that are kind of pushing back on the dollar bearish trend, and perhaps suggesting that the dollar may be in the process of fundamentally bottoming out. However, I'm not ready to jump to that conclusion, as the overall USD impact has gone from a very sort of low score to now a middle point score. So if this starts to tilt to the other direction, perhaps there's some dollar strength that could come out of this. The euro dollar is modestly lower here today, and I am bullish on the euro, but definitely would be more interested if we actually got a pullback on this chart, perhaps something like a move back to 1.14. Pound dollar, similar story, looking for a move back to 1.36. The dollar yen, I'm very neutral on. Dollar Swiss, potentially a short position if you got to move up to 0.81, depending on what the economic data looks like at that time. And the dollar CAD would be interesting to me at a move up to like 1.3850. The Australian dollar also seems to be breaking out here. Let's see if this can continue to push higher. Looks really strong right now. The New Zealand dollar versus the US dollar also trying to break out here. And for the currency traders, let's also take a look at the Japanese yen. The Japanese yen here getting a low score on the Edge Finder here when it comes to our Japanese economic heat map. What we can see here is that, of course, we're getting several bearish readings from things like retail sales, which came in a little bit soft. Manufacturing PMIs came in a little bit softer than expected here. And we also have inflation ticking lower here in Japan as well, from its 3.6 down to 3.5%. Producer price index also came in a little bit soft in June. And the unemployment rate rate stayed steady at 2.5%. So when it comes to the Japanese yen, what currencies would I be potentially interested in trading it on? Well, for this, we can use the economic surprise meter, which shows us across all currencies which ones have strong performing economic data versus weak ones. For example, New Zealand and Euro are getting currently some stronger readings on the economic surprise meter. And then you have things like the Japanese yen and the Australian dollar getting a softer reading or a weaker reading, suggesting that if you'd like to pause, we'll actually pop this up so you can look at this a little closer on the screen right now. Basically, higher scores indicate that the majority of key economic metrics favor a stronger currency for the country, and a lower score is the exact opposite. So right now, some of the currencies that are getting strong readings are things like New Zealand and Europe, and some of the weaker ones would be things like the Japanese yen and the Australian dollar. So simple logic would tell me that I'd be most interested in things like long Euro yen or long Kiwi yen, in this case favoring the stronger currency over the weaker one. So Euro yen, however, has already kind of made a big push. And so for me, what would be required in order for me to possibly get an entry would be a pullback into some level of major support looking left. NZD-JPY is also sitting at resistance. So there's two possible trades here for me on the Kiwi yen. Either a pullback down to the 86 level or a break and retest at these current levels, showing buyers are in control. And I do think that the ultimate move for the Kiwi yen is a return to something like the 89 level. We do also have a stock surprise meter, and using some of the economic data, we can then use this to determine which stock markets based on the economic data look stronger versus weaker. For example, the Canadian stock market looks relatively strong versus expectations, and same thing with the DAX and the Nikkei. Conversely, some of the weaker stock markets would be things like the UK or the FTSE or the Australian stock market. And then we have some of the neutral ones being things like the S&P 500, the Swiss franc, and the New Zealand stock market. Now, notice that this is specifically based only on the economic data for these countries, not necessarily anything else. The average overall global score, which kind of takes into account all major stock markets that are listed here, is getting a 55% score, which is sort of in the middle, slightly leaning bullish. Interestingly, we are seeing some very strong divergence in the US indices today. Let's zoom in over here and take a look at what we're dealing with. You got the S&P 500 sort of flat, the NASDAQ down by 1%, but the Dow Jones up 0.8%. Following suit is the Russell, slightly higher here today. The German DAX is down almost 1%, and the Japanese stock market tapping into its all-time, well, not quite all-time highs, recent highs, not quite at their all-time highs, but tapping into those highs and now pulling back here today. This is a stock market I'd be interested in potentially getting long on if you get some pullbacks. And today's video is sponsored by 8cap. If you're looking to get access to the Edge Finder completely for free by signing up with our partnered broker 8cap, there will be some information about how you can do this. Please note this is available to only traders outside of the United States who can trade with 8cap. So all you have to do to find information about how to do this is go to a1trading.com/8cap. That's a1trading.com/8cap, spelled like the way you see it on the screen right here. Essentially, the way this works is that you create an account with 8cap using our specific link. You have to use our link, otherwise you won't get this credit. And then what happens is essentially if you deposit the required amount as listed on the website page, you can get access to the Edge Finder for free. Essentially, 8cap purchases a copy for you based on your deposit. So find out more information by heading over to a1trading.com/8cap. Let's talk about the tax bill stuff, and let's talk about the tariffs, okay? Now, on my channel, I do my best to kind of remain as politically unbiased as I possibly can. But this stuff really impacts markets. What you do with a tax bill and what you do with tariffs, it impacts what is most important to the stock market. You ready for what's most impactful to the stock market? Does anybody know what? Drop it in the chat really quick. What do you think is the single most impactful thing to whether stocks go up or down? And I'll give you my take in just a second, but I just want to give you guys a chance. What do you think is the most impactful thing to cause the indices and everything else, by the way, the dollar, gold, all of this stuff? What moves markets dramatically? You ready? Sentiment is a really good one, but there's one more. There's one more thing that I would say moves the market even more than sentiment. Well, I mean, this answer kind of, it goes with sentiment, to be fair. This is it. Monetary policy, but more so specifically, stimulus. That's the word. Stimulus is ultimately what moves the market aggressively. Why? Because if stimulus in the markets is aggressive, like if this tax bill adds stimulus to the market, if it makes it so that tons of money floods into the system, right? And that may come at the cost of taxpayers for kicking the can down the road. But the stock market doesn't care. The stock market says, if you're going to give me tax breaks, if you're going to give me stimulus, if you're going to put money in people's pockets, companies are going to rip. Now, again, I'm not saying necessarily that that's right or wrong, because we could also point to tariffs and say, well, tariffs could be a tax to the consumer. It could actually hurt the ability of the consumer and could take away from the stock market bullishness. This is ultimately what the stock market and the indices are hunting. They're hunting, is there stimulus here? Is there stimulus here? Is the Fed going to give us stimulus by cutting interest rates? Or is AI going to give us stimulus by making companies more efficient and causing higher profit margins? That's what the stock market obsesses about, is stimulus. Because if you get an environment where taxes are cut for businesses and things look more favorable towards businesses, or gives people more money to spend money, right? The stock market just says, then companies demand high valuations. And higher valuations means that the stock market as a whole continues to move higher. I know Powell is speaking. We're keeping an eye on it. If there's anything that is said that is of substance, we're gonna address it. But I have a lot of charts I want to get through today, and I'm keeping an eye on headlines. If anybody has headlines from Powell that are really interesting, let us know. What is stimulus? Good question. So stimulus is simply the idea of money flooding the system. In the pandemic, right? The Fed cut interest rates dramatically and the stock market absolutely ripped. What happens when you cut interest rates? People can borrow money at lower rates and they go buy money and inject money into the system, inject money into the markets. Companies make more money because money's flooding in. If the Fed cuts rates or the government spends money in the form of cutting people's taxes, right? The stock market loves it. Now, again, I'm not saying whether or not that's the right call or not, because it could cause the stock market to go into melt-up mode and ultimately could crash back massively. We don't know. But the point is, the idea of obviously cutting taxes, the standard Republican kind of idea is like you cut taxes and take in less from a government level, reduce the size of your government, and then, companies, the private sector gets bigger, stronger, and gets, they do more of the heavy lifting than the government. But of course, there's some downsides to this. Elon Musk has been very critical of the Big Beautiful Bill because it sort of follows suits with the standard politician. Now, again, I know I'm not trying to get political here, but it doesn't really matter if you're talking about red or blue presidents. But there is a standard here in America about how you get votes, which is you spend a ton of money and you add debt to the national debt. And this theory, in my opinion, if you do continuously to cut taxes, right, it adds to national debt. Tariffs, tariffs are largely seen by economists as just another way of taxing people in a different way. So where they may cut taxes over here, they may just collect those taxes over here in the form of tariffs, right? So it's just kind of moving money around. It's a weird concept. That being said, I think the market is mostly excited about the idea of lower taxes. And this is, if you go back and watch the streams and videos during this time or during the election time, this was what everybody was talking about too, is like, tax cuts and more efficiency from that side of things. And so that was the exciting. But then we got more news on the tariffs, which caused the market to tank. Since then, we've seen tariffs sort of the worst case scenarios were put to the sidelines, and now we're focused more on the tax bill. So to me, it makes more sense that the market continues to push higher. So we've got rate cuts and tax bills on the docket. To me, that suggests that stocks should move higher overall. And so I'm a buyer of any dips that we may see in the coming weeks and months. That's a perspective that I have and is largely reflected in the Edge Finder's top setups page. If I go to indices We have bullish ratings on the DAX, the Nikkei, the NASDAQ, and the Russell. Part of this is because we've got cooling inflation, which is a rate cut stimulus, right? So if you ever want to know where indices are going, one of the most important things, in my personal opinion, is keep this in your back pocket. This word, stimulus. Did I spell it right? Not sure. Stimulus is the word of the day, okay? It can come from the Fed. It can come from the government, kind of the same thing, but from fiscal policy, from monetary policy, and it can also come from just straight up businesses making so much money and stimulating. Like, for example, NVIDIA, this AI stuff is a tailwind to the rest of the market because so much money is getting spent on chips, and that's like just it's a stimulant, right? You see what I'm saying? That's what we're trying to study when you're talking about indices from a macro perspective. Keep your eye on the ball. Money flow, stimulus. That's what makes indices rip higher. Why? Because companies get valued at higher rates when there's tons of optimism, speculation that more, profits are going to come in for companies. At the end of the day, more stimulus. The reason that's so bullish for stocks is because it means that the stocks within the indices are expected to make bigger profits. That's ultimately what drives stocks, is earnings per share growth. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.